The crash of crypto markets offers a lot for investors in physical gold and silver. But will we learn the lessons from cryptos, or will we crash like that market? Forget the crypto market versus the gold market debate. I am fully aware that many of us precious metal investors were, let's say, rubbed the wrong way by some of the comments, attitudes, and etc. that we got from the crypto community. Regardless, this is not a time for I told you so, gloating, or anything like that, as millions of people like you and I have been hurt by this crash and got stuck holding the bag, especially because it's the average people like us that are trying to have a better life that got hurt, not the big money or institutional investors. If you're one of those people, my heart goes out to you. I also know that many people have had thoughts of harming themselves in the aftermath, and I encourage you to seek support, as what you are dealing with is a temporary problem, and choosing to take your life is choosing a permanent solution to a temporary problem. Not to mention the pain your loved ones will experience by your loss. The focus here is on how we as individual investors can learn how to avoid being taken advantage of by institutional investors. Estimates are $1.7 trillion has been lost. While we use that phrasing, it doesn't tell the full story. See, the money wasn't lost. It was simply transferred to someone else. So what does this have to do with us holders of physical gold and silver? Well, as sad as this crypto story is, the crypto mania is no different than any other mania or bubble that we've experienced before. Before we gold and silver investors start strutting around like peacocks talking about digital gold, it's important that we remember that today's peacock is tomorrow's feather duster. We have to remember that we have seen this movie over and over and over again. As my mother used to say, which came from the book of Ecclesiastes, baby, there ain't nothing new under the sun. What you're doing, I did, and people before me did, and your children will do. This gets me back to this just frustrating point of, aren't we all tired of the greater fool theory? Aren't we tired of being the fools that rush in late? Aren't we sick of institutional investors sucking us in, fleecing us, and then leaving us with broken dreams? This story is so old and I'm just sick of it. The school system doesn't teach us, and we have to figure it out along the way, or we just do the best we can. I like to think that what we do with this channel is teach, and as a lifelong educator, I know that only a small percentage of each topic will be retained. This is why I share concepts that are universal truths, and we always cover the important topics multiple times in a variety of ways. As I learned in college, when your professor covers something more than once, it's going to be on the exam. Well, in this scenario, the exam is life. And ironically, just like in school, if you don't learn the lessons and you don't pass the class, you have to do it all over again. So this brings me all back to the crypto mania. And I call it that because it's similar to the world famous tulip mania. And the anatomy of an investment bubble that came out of it is where I'm going to lead us. Take a quick look at the screen. And for those of you that are keeping score at home, yep, this is now the third time that I've covered the concept. Do you think it's important? Do you think it's going to be on that quote unquote life exam? Of course it is. And I would argue that with the anatomy of an investment bubble, a good bit of emotional control, solid investing knowledge, thoughtful consideration, and basic observation skills, you can do just as well as insiders with their fancy computers and algorithms. Bob Moriarty, I just love that old dude. He just keeps it so simple. That's an aside. In a recent interview, he said, there are a lot of things you can figure out if you use common sense and ask the right questions. Before we dig into this chart, as a quick reminder, the anatomy of a bubble was developed by economist Hyman Minsky, which breaks down the 5 stages of a bubble. This theory came out of a real situation that started in the Netherlands in 1634 when tulips were first introduced and reached ridiculous price levels, which led to a dramatic collapse in 1637. Like Beanie Babies, but with flowers. It is generally considered to be the first speculative bubble or asset bubble in history. Unfortunately, it doesn't appear that many of us or that we have learned from this lesson. So let's dig into the chart and pull out some additional key lessons that I think are particularly important. If you look along the x-axis, you will see the mania phase, and that's where we're going to focus on today. Because if we handle the mania phase correctly, The blow-off phase will be clear and you will largely be out of harm's way. This is especially important because by the end of the year, we should be entering the mania phase as gold and silver investors. When a market hits the mania phase, people start making money, and that good hormone, that happy hormone, dopamine and others start to really kick in. And if you're a long-term holder of gold, it's going to feel amazing. Finally being vindicated after all these years of holding, being ridiculed, being told that gold is a boomer generation investment, blah, blah, blah. Those feelings and that euphoria is going to make you feel out of this world. And that is when the trap is set. You start to believe the hype and the enthusiasm. The greed starts to take a hold as you begin to think about life-changing amounts of money that you've made. Many of you have seen this slide before, and I love this slide. And of course, there's a little pun in there, the facts of life. But the reality is this: the higher your emotions, the lower your thinking. They work in this kind of teeter-totter way. And so it's hard to have them both high at the same time. And so when you get overly emotional or overly excited about something, your thinking tends to go down. I want you to think back to a few years ago and recall what the crypto investors were saying and thinking. Remember, at one point, there were more than 10,000 cryptos to choose from. Now, you tell me if that makes sense. Of course it didn't and doesn't. Think back to other bubbles like real estate in 2007 or the dot-com bomb. My point is that it becomes very easy to look back and see how inflated or ridiculous those markets were. But in that moment, it's hard to stop drinking that elixir. This is why I preach several concepts which happen to be not so popular in the stacking community. And I really think it's because I first learned how to be an investor and then later became a stacker. I see my metals as investments and not just for the role they play as being a hedge or storage of wealth. I want you to take a look at the screen for some of these key concepts that you've undoubtedly heard from me before, and we're gonna go over them. But before that, if you find value in this video, hit the subscribe button because Stackers is here to help you get the most metals for your dollars, and I don't want you to miss a single video. Plus, it helps the channel grow and more people get to hear about us. Also, give yourself a thumbs up and give me a thumbs up for taking the next step towards greater wealth by clicking that thumbs up button and checking out the new animation that comes with it. Also, it helps me defeat that evil monster, Mr. Algorithm, and he needs comments, likes, so please make sure you do all of those things if you haven't done before. Lastly, make sure you head over to Silver Forever's channel to see the feature that he did on Stackers University and the Silver and Gold Stack Attack. Back to the concepts I want to share. One of those is pigs get fat and hogs get slaughtered. This is about our ability to be willing to leave an investment early. It's okay to leave a little meat on the bones. Let the vultures pick that meat off the bone. The next one is half a loaf is better than no loaf at all. Similar to pigs and hogs, but if you find yourself with half of what you had, take it and be happy. Don't hold on to an investment or something because it used to be worth more and you want to get it back to where it was. Listen to the crypto people. You hear this narrative over and over again. Next, you never go broke making a profit. Lost profits are like fish stories. Nobody wants to hear about how big the fish was that you lost. Either you catch the fish or you don't. Either you make a profit or you don't. Next, take money off the table. As a gambler, you learn that the money is not yours until you walk away from the game. So bank some profits along the way. Don't wait until you're holding half a loaf of bread to then say, this is enough. Controlled aggression is another one that I really love. I'm not a big believer in the traditional idea of diversification. I think it's a sucker rule that they came up with for the masses to maintain control. While I always invest aggressively, I've learned that it also has to be controlled aggression. While I'm a giant believer in precious metals, I also invest in mining stocks, another thing that's not very popular with precious metal stackers. Shh, don't tell anyone, but here's a little secret. When the time is right, I'm gonna also buy some paper, silver, and gold. Why? because of the leverage it offers me. The difference is when it hits a certain level or I hit a certain level of return, I'm going to bail out. I'm not going to be stuck holding the bag. I know it's trash, but just because it's trash doesn't mean there isn't money to be made in there. I know, that's not popular in our circles, but let me tell you, broke, depressed, and hard to get along with ain't popular in my circles. So guess which one I'm going to choose? The next one is the chip on the shoulder, usually means a block for a head. Don't think that you know it all. While I'm here hosting this channel, I never think that I know it all. I do my very best to do all the research I can to make sure that I give you good information, but I know I don't know it all. That's why our slogan is always stack smarter and never stop learning. How many crypto know-it-alls lost untold amounts? Just scan the newspaper and you'll see story after story of how people lost billions and average people lost millions and hundreds of thousands of dollars. Velocity of money. Again, this is another not so familiar or even popular concept in these parts, but how quickly you can get your original capital that you invested back matters. Remember, once you get your original money that you've put into an investment and you still have that asset, you now have zero risk and an infinite return on your money. For me, I knew cryptos were near the top when in late 2021, I heard my grocery store baggers talking about how much money they had made in cryptos. Just think about that. I submit that if you can commit to truly understanding the anatomy of an investment bubble chart, learn to exercise a good bit of emotional control, continue to learn solid investing knowledge by following Stackers University, come on, you should all know by now that I have no shame in plugging the good work we're doing here over at Stackers. At any rate, and with some thoughtful consideration and basic observation skills, you can become an incredibly successful investor. As Bob Moriarty shared, there are a lot of things you can figure out if you just use common sense and ask the right questions. My questions for you today are very simple as well. When gold and silver reach a bubble status, what's your plan? Do you have an exit strategy? You need to develop one. What piece of advice shared today will stick with you? If you can't think of anything, then just put hey or hi in the comments. It will let me know that you are one of my A students because you saw this video all the way through. Plus, it will help us defeat the awful, mean, terrible Mr. Algorithm. Always stack smarter, folks, and never stop learning.